into the Clubhouse room. Joyce is I invited Joyce on there. She said she's been loving Clubhouse. Are you listening to much in there? Are you spending much time in there?
Yeah, I'm getting on it a little bit, which is good. And welcome Sharon to Clubhouse as well. So she's jumped on as well. Yeah, I'm listening obviously where I can, which is good, and just learning really how the system works, to be straight up with you. But there's been some interesting content. I've actually got a few people over in the UK. Clients / friends of mine, and listening to what they have to say over there. So, it usually seems a bit more of my night routine that I'm putting the earphones in and just having a listen to a few things, and rather than watching something, which is good.
Fair enough. Yeah, I haven't actually been spending much time on there at all. I can't. Particularly during the day, I can't work if I can hear voices. It's just too distracting for me. Like, even if I'm listening to music, I can't listen to music where there's a whole lot of lyrics to it. It gets too distracting for me. But anyway,
that's it, mate. That's it.
So we're live on LinkedIn, Facebook, Twitch, and we're giving Clubhouse a go. We're all over the place today. John and I are back to have another chat. We did this last week, 12:30 last week. And we thought we'd have another chat today. It was a bit of fun. We've got a couple of people in the Clubhouse room. Mina's looks like he's on LinkedIn watching. So Mina, hello. Thank you for joining us. John, do you want to intro the topic that we're going to talk about today?
Yeah, beautiful. I think there was a topic that there was you put on LinkedIn, which was interesting, about the way that you structure certain things. James, if you can just put the volume down on Clubhouse, because I'm hearing myself echo really bad.
Yeah.
Yeah, no, you're right, mate. Yeah, no, obviously you put it in regards to how you structure investments, and obviously, how people kind of bucket their money. And it's a very interesting topic because, different advisors kind of do it different ways. And me and you obviously have a very similar way in the way that we kind of do things. It's slightly a little bit different for one person and the other, but it was really to kind of explore that and the reason why that is the case. And, I think today we kind of just, discuss about, the three buckets and obviously maybe potentially some other philosophies that other people have, or what we've come across. So,
Graham's jumped on. He's watches from the Philippines. He's on the LinkedIn. Yeah. So
beautiful.
Yeah. So the three buckets, I guess, approach, and maybe just start what does it even mean? So we kind of, I guess, just a different way of segregating. Hey, you've got a certain amount of money, and what is it for? How are you going to use it, and how best to structure it? I guess is the approach.
And I think the way that I kind of structure our buckets is obviously there's a short-term bucket, a medium-term bucket, and a long-term bucket. And the short-term bucket is really for us the safety bucket. That's the fallback position. That's cash orientated. It's not gonna help you live a financially free life, but it's there to just support in regards to emergencies. And to be totally honest, it's been really, really good through COVID, is what I was about to say. Sorry, Sharon was just saying that the audio was echoing for her. So sorry about that, Sharon. We're learning the system, but I'll fix that up. So the gist of it is that the safety bucket is the first bucket. So especially during COVID, when markets were correcting themselves and obviously really crashing and doing, weird and wonderful things, it was really good that people could have that safety bucket that was there for when they needed it. They didn't need to worry about, was it affected by a market? Am I going to have money for emergencies or safety or daily living or whatever it is? That money was being there. So, as much as the safety bucket is not cool and sexy and, it's quite boring, it works a really, really, really important role in any portfolio management and any wealth creation strategy to make sure that we have that safety bucket. And I saw that was very similar to you, James, and maybe just elaborate on your first bucket.
So ours is the way that we do it is, I guess, similar. The whole three buckets thing and we separated out. It's based on a client's circumstances. So our view is that someone's circumstances in relation to their money and managing their money is to say, well, you've got a certain amount of capital. So there's you've got $100,000, you've got $1 million, whatever the client might look like. You've got this capital there. What level of regular income do you need from that capital to support your lifestyle? And so that's going to differ for people of different ages. So I'm out of my 36, working. My life is funded by me going to work, not by drawing an income from any investments that I might have. Versus someone that's 65 and retired and they're not working anymore, and so their lifestyle is being funded by drawing an income from the capital that they've managed to accumulate over their working lives. So we say someone's circumstances is this: you've got a certain amount of capital. What level of income do you need from that capital to support your lifestyle? And then we break it up across those three buckets. So we set aside 1 year's worth of these covering this lifestyle expenses from cash, being the first bucket. The second bucket, term deposit and interest-bearing type investments. There's a few different things that go into there, but for the purposes of this, just earn some interest. They're not trying to get some growth or anything from them, just a level of interest in there. It's a bit of a backup. Set aside another 3 to 4 years worth of whatever that spending need is in that second bucket, and then the rest sits down the end in the third bucket, which is someone's growth allocation. So whether that's investment properties, shares, overseas investments, whatever it might be, there's a mix of different things that all fit into that end bucket. And what we're trying to do through all of this is just try and buy as much time as possible to hold on to those growth assets at the end, to try and get clients in a position where they can just hold on to those for as long as absolutely possible. So that second bucket, that interest-bearing bucket, will earn some income. We have that paid across to top up the cash account in the first instance. Same thing with dividends or rent or whatever might make up that growth part at the end. All of that we have paid back to the cash account, and then through the regular meetings that we have with clients throughout the years to say, well, the cash account's built up. Maybe that's paying someone's lifestyle, so the cash account doesn't actually build up that much. There's a regular amount of money coming out, and it's being funded by this income. Or for the 30-something-year-old that's got some money and is working and doesn't actually need that to live from, the conversations say, well, this cash account's built up. Do you actually really need any of this money today? No, James, I don't need any of it. Okay, so then we work out which of buckets 2 and 3 are we going to put that money back into to earn even more income the next time around. So that's
and so I think it's very important to illustrate to people that, for people with wealth, and we're talking like, just for example, let's say someone's got $1 million, it's pretty easy to illustrate, 1 year's worth of that, 3 to 4 years, and then obviously, the growth bucket but for people starting out, it's sometimes not cool or sexy to be building up a safety bucket. But, it's like a house. You've got to build on the right foundations. You have the wrong foundations or have poor foundations, and that house is going to come down. So, I think from a wealth creation perspective, building those buckets over time is very important. I think a lot of Australians need to be mindful that the government many, many years ago helped to build that long-term bucket, that real growth-orientated bucket in regards to superannuation. And so, for the younger generation, in their 30s and 40s, or even in their 20s, you can start to see buckets forming in front of you without you even knowing them. And I think having them illustrated helps with the journey in itself. And I've found over the time it's the middle bucket that has this so much of, what do we do with it? And I think, most advisors in regards to that long-term bucket is, usually around equities and or shares and property. Obviously from the safety bucket or the first bucket, it's usually always, cash orientated. But that middle one is obviously where things are kind of moving rapidly. When you've got term deposit rates giving 0.3% or 0.5%, it's like, is this safety or is this an income generating? And I think, we're starting to see in markets, bond yields dropping. There's a very, very low interest bearing from some of these defensive assets. So, sometimes people can get like, oh, let's just move it over to, a growth orientated asset. And, you've got to be very, very cautious on when you're doing things like that. You're exposing yourself to potentially more risk than you need to. And I think the bucket strategy is held up in the test of time and in testing times as well. GFC, COVID-19 situation, and I think, James, as well too, it needs to be monitored and managed. And I think this is the big one. Like you were talking about those regular review with your clients, like we do, making sure that all the buckets are being filled the right way. Potentially if you get overexposed in the growth bucket or overexposed, it does create some unnecessary risks and needs to be managed accordingly.
Yeah, exactly. It does. And so and I'm sure you probably saw this, in the putting aside the last 12 months, but the couple of years leading into that, as interest rates on the term deposits, you're saying how low they are, as these interest rates kept coming down and down and down, I would regularly have conversations with different clients, and they're saying, James, why are you telling me to just leave this money here? I'm only getting 1.5%, or what was 2 or 2.5%. My shares are flying. Can't we just buy some more shares? It's like, well, no, we need to just stick to the plan. That's there for the rainy day money. And you just kind of look back and think, imagine if we had have just gone with the clients trying to push it in one direction and almost not held firm on what we're trying to do and to a level protect them from themselves. If we had have just gone, oh yeah, let's buy more shares and really ramped up that growth, it would have looked good for a couple of years, but last year would have been absolutely horrendous for these clients. And so, fortunately, we put the brakes on a bit of that. With those buckets 1 and 2 that in the model that you tend to use, what type of guidelines do you work towards as to how much in each of those? Like, where do you get to?
It's an interesting one. I think you said, for example, like 1 year, and our bucket 1 is 1 to 3 year time horizon, actually, depending on the person's risk appetite. Yeah. And so, so between 1 to 3 years tucked away in the first bucket. From our second bucket is between 3 to 7 years, and then from 7 years plus. Yeah. That's how we divvy up in regards to the amounts that are in there. Now, obviously, they differ depending on age group. They depend on risk appetite and overall requirements. And I think that's where the art comes in making sure that that's customized to each client correctly, and that they've got enough in the rainy day and they've got enough to enable them to grow to reach their goals and aspirations. So that balancing act is very hard. And for most advisors and most clients, it's not exactly the easiest time. You can't just throw your money at everything and it make money, even though people may think that to be the case. Usually, most cases, they're temporary. So, we've got to be on this. Yeah.
Just messing around with my AirPods to see if they can stop the echoing. I don't know. Is the echoing still going?
I think it might be echoing now, and I apologise for that. I think every time I speak, I need to put myself on mute. So we'll see how we go. Sorry for the people who are hearing the echo. I do apologise
if it was echoing or not. Yeah, so it's interesting, the kind of the different approaches, and the different. We obviously work in different businesses, and so you have different approaches to achieving the same kind of thing, and ultimately, probably getting kind of similar kind of outcomes, but just how you get to it's different. And so I guess there's no one size fits all.
There's not, and everyone has their different craft, or different philosophy. And I think this is where clients need to make sure that if they're going to work with an advisor, that they understand how they work, the way they think, the way that they operate. And, I encourage people, if they're going to go see a financial advisor for the first time, understand how they go about things, understand how, what their philosophy is and how they, utilize people's money, but also how they feel and how they react to certain things, During the COVID situation, I had so many potential clients calling me, you know, I've just lost 40% of my money. You know, I can't believe my advisor did this. Now, I always know there's two sides to the story, and understanding these conversations, you know, these people couldn't help themselves but fall into that growth trap and, you know, on the way up. And so, you know, I tell people straight off the bat, I am by far not the most aggressive advisor. I'm not there to go, you know, grab all your money and let's go on red and whoop, did you? Yeah. You know, I'm probably more cautious on when people, you know, are making a lot of money. And I think it goes because my philosophy is very much aligned to that famous quote, you know, be fearful when people are greedy and be greedy when people are fearful. And so for me, you know, I say that from the get-go, and I think that differs from me to potentially someone else and to the next person, you know, and you find that at conferences where you may knock into an advisor and how are you, blah, blah. And, you know, me and you, James, might have similar philosophies, but then you speak to another person and it's not. It's, you know, a matter about, you know, finding particular stocks that are doing well and, you know, shorting them or trading them and whatnot. And just like, you know, for me, that's just, whoa, you know, I'm not here to time the market. I'm here to, you know, time in the market. So, you know, for people that are listening, and you're thinking about potentially working with an advisor and understanding a bit more, understanding how they tick is crucial in regards to the money management, not the fancy documents that they got on their website. How do they think? Interview them. You know, if I'm going to go work with someone, I interview them. I want to know this, and this is crucial. This buckets theory for me, if I was looking for an advisor, that's what I'd be looking for, and understanding how they operate that and how they move that is very important.
And do you find, and I've just the last couple of interactions I've had with newer clients, a couple of them have said somewhere towards the beginning of the, you know, kind of initial conversation that we might have, they've said, we'll probably talk to some other people, and I kind of turn around and say, well, you should, you know, you ideally you're wanting to try and form a long-term relationship with someone that's going to help you through, you know, a big part of your life, whatever your age might be at the time, but they're hopefully going to work with you for a period of time going forward. You need to actually, you know, get along with these person and actually, you know, be providing the things that you're actually wanting. So do you need a whole lot more education and hand-holding, or maybe you don't? And so you need to, you know, try and find people that are going to align with what you're looking for. And yes, I often encourage people to say, well, you should, you know, like, maybe I'm the first person you've spoken to, maybe I'm the third person you've spoken to, but, you know, that's good that you've spoken to different people. We'll have different philosophies. We'll charge slightly differently. So you need to just find something that gels with you, and don't just, you know, potentially go with that first, you know, recommendation that your friend made to go and speak to John. Maybe that's great, maybe that's not, and so you need to
I do the same. I encourage people to look elsewhere. I had a client yesterday actually come on, and I know Joyce wants to speak, so we'll get her up on stage in a moment. But I had a client yesterday say, you know, John, I want to, you know, I'm committed to you already, and I'm like, just calm down, you know, go speak to some other people, or at least, you know me intricately. Yeah, give me the opportunity for you to understand me, because this isn't a one-off transaction we're talking about here. You know, we've got a relationship, and it's a journey together. So I'll invite Joyce to speak. One sec, and maybe James, you put it on loudspeaker on your end.
Okay.
Hi, can you hear me?
Hi, Joyce. Yeah, we can hear you. We're just trying to work out how to do the LinkedIn part as well. Yeah. So if anyone's on LinkedIn, bear with us if it's echoing. Yeah, go for it, Joyce. Good to have you join us.
Yeah, first time speaking at Clubhouse. Thanks
Welcome.
For the invite, James.
That's all right. How are you finding it? You were spending a bit of time in here?
Sort of just random. I probably listened to like 2 full ones, but it's sort of like in the background.
Yeah.
Good Times is one that I've listened to. It seems to be quite interesting, like, you know, about remote working.
Oh, yeah.
I'm always interested to hear how people are juggling that. But enough of that. Back to wealth management and safety buckets. Yes, yeah, very unsexy topic.
Yeah.
It is. Would you say that having cash in an offset account is considered a safety bucket? Yeah, random question. Anyway.
Yeah, John, I would say yeah, and so that's the whole. This whole. Certainly, in my view, that you kind of 1, 2, 3 buckets. That first bit is about trying to have some level of safety, so that the spending. If you've got a mortgage, well then you should have that in an offset account. There's no point having that somewhere else that might attract a little bit of interest, provided that you're not going to get sticky fingers and go and spend the money too. So you need, if you've got some self-control and you can separate it out. And so, like for me in my own finances, I actually have a number of offset accounts. So my pay goes into one, and then money goes off to another. But I separate it out completely, so that whenever I look at my banking, there's only one much smaller account that I'm actually doing the spending from, and then the bigger savings that I've got that's actually offsetting my mortgage is in a separate account that I'm not really spending from. John, have you got any input on that?
Yeah, so I would say it is, because at the end of the day, all we're doing is offsetting the money to get a better interest rate or to save you on some interest. So, listen, I think for people who rip out equity, and then just put it into an offset account and continue to do that, I would still say yes, it's technically still safety money, but you should be trying to manually build that up yourself. Yeah, it shouldn't be just falsified. I think you can do it, but it's like you putting down on your weight tracking app that you're 70 kilos when you're really 80. You're just cheating yourself in that scenario.
So Joyce, are you just in terms of like money in an offset account? Are you just referring to money that you may have saved, or what John's referring to there is going to the bank and releasing $50,000 equity that from your home and just having that sit in an offset account and not use it? You've kind of artificially created this offset and this safety account. Really, it's more borrowed money that you've got, rather than money that you've saved and put in the bank account.
Understood. Yeah, then that scenario would be absolutely pointless.
Yeah.
But yeah, so yeah, I think that self-control is important. So I'll keep that in mind.
Yeah.
I was thinking more like, salary goes in, as you mentioned, and then hopefully, it stays there.
Yep.
As much as possible.
That's it.
Thanks for that.
No worries. Thanks, Joyce. What else have we got to talk about? I don't know. We'll go for half. We'll go for half an hour.
We've got about 5 minutes. I've got Sharon on the line as well. I'm going to put her on the spot here. Sharon, raise your hand if you're willing to ask a question.
Or quietly leave the room. If someone put me on the spot like that, I'd be like, I'm out of here.
She raises her hand. She's lovely. 1 second.
Hello there.
Hi, Sharon.
Hi, Sharon. How are you?
Yeah, good. This is my first time on Clubhouse in one of these rooms, so
it's only our second time. We hosted one last week, and it was just the two of us talking to each other for half an hour. It was good fun, but anyway, thanks for joining us.
Oh no, it's good. I was thinking, this is a good medium to pick brains.
Yeah, that's what it's for.
If nothing else, and I have absolutely no questions.
Sorry. No, that's okay. Thanks for joining us. I know John and I were toying with we did it last week, and we kind of said, should we do it again? And anyway, so we're here now. Putting John on the spot. Do we want to try and make this a weekly thing? See if we can.
Yeah, we'll see how we go. If Joyce and Sharon like us, we'll get them to invite their friends, and hopefully we can have a bit more on Clubhouse.
I got no other friends on Clubhouse yet.
Yeah.
That's it. But we'll have to work it out. We'll see what we can do. I'm sure we'll get it up and running. But no, I think two different minds from two different total businesses sharing their views about money. And, you know, I've been saying to people, 2020 was a lot about, you know, health and obviously the coronavirus and what was going on, but a lot of people were thinking about money. And, you know, for the people who don't have an advisor, I think this is a really good way to even just understand a little bit about how we think and what we do and how we go about things. But, you know, be sure to DM us or, you know, private message on LinkedIn or whatever you need to do, and, you know, give us some questions, and maybe me and James can kind of put, like we said, a weekly thing together, you know, answering some of your questions, really just, you know, being as valuable as we can to the community.
I think you should do it. I'll tune in each week.
Yeah, thanks. Well,
Thanks, Sharon. Thanks, Sharon. I'll Joyce wants to join as well, so I'll invite her to speak.
Okay.
Joyce?
Can you hear me?
Hey, how are you?
Yeah, I was just going to say, no, I think you're onto a really good thing, because I think Clubhouse is perfect for, financial planning, because especially about behaviors and money, the more people listen to it, like me, the more the message kind of sinks in. Because I've been needing to get my finances sorted and, you know, get legit and all that for ages. But then if someone's just, in the background talking about it 24/7, that's definitely something I would tune in, because it's like, I want to change, but I just need help. So definitely give it a good crack.
Yeah,
cheers.
That's it. Hopefully me and James become like, you know, when you open up the fridge and you're trying to lose weight, you open it up and you see that beast that says don't eat the donut. Yeah, hopefully that's us when it comes to finance.
Exactly.
Right?
Yes.
But yeah, thank you very much, ladies, for jumping on. I really appreciate it. If obviously you guys have any, or ladies have any more questions, please let us know. But, you know, I think, you know, there'll be a range of topics that we will be covering from, you know, all facets of advice and wealth management. And I think, you know, some of the main ones, you know, we'll speak about will be around cash flow management, how that works and how that operates, the, you know, big discussions around investments, but also topical situations as things move and as things change. You know, it's a matter about speaking, you know, really about what's going on. So, you know, a weekly thing is probably good, because in our world, it changes every minute. So, you know, we'll try and keep as topical as we can.
Yeah, good. There we go. We've committed to it. Good stuff. Well, thank you both for joining us. So Friday next week we'll be back. We'll schedule it. I don't know, maybe 12 or 12:30. We'll have to just compare diaries for Friday next week, John, to see when we're both around. And
PS followers, me and James live about a stone throw away.
Yeah.
I reckon I could use a slingshot to hit his window. Yeah. So we might need to do one in person as well. So change it up a little bit.
That's a great idea. Today I'm pretty chockers today, but yeah, we should. I'll come to your house, or you come to mine, and or your office down the road, wherever. And
that's all right. I'll sit on your kid's bed. You sit on my change table. Right.
Yeah.
Anyway. All right.
Good stuff.
And
all right.
Thanks everyone for joining.
Thanks, John. Thank you.
If you've got any questions, let us know, and any topic ideas, we'll be happy to cover them.
And
have a great weekend, everyone. Thanks, Joyce. Thanks, Sharon.
Thank you.
Bye, everyone.
And on the LinkedIn there, Mina, thank you for sticking with us. By the looks of things, you're still there. Graham, if you're still there, thank you for jumping in as well. We've got to recruit to the Friday lunchtime live with John. So we'll see you next week. Thank you for tuning in, John. Good to see you.
Cheers, guys. Thanks.
See ya. Bye.